Hello everyone. So we'll be taking up with the next question of retirement today, that is exercise question 15. First of all, mark it as an important question as it covers a lot of important points. Okay. One of the important points of capital adjustment, when we solve it, you'll understand it. E, F and G are the partners sharing profit and loss in the ratio of 4:3:3. Mark it as old ratio. E retires on 31/3/17. E retires. Who retires? First partner retires. Okay. E means first partner retires. On 31/3/17. Balance sheet of the firm on that date was as under. General reserve put tick. We will be distributing between all the partners in the old ratio 4:3:3. Then goodwill put take, will be distributing it between all the partners in the ratio 4:3:3. Cash put take, will be writing it as the opening balance. Following terms of retirement were decided in partnership agreement among the partners. We'll read the adjustments when we solve it. You're asked prepare profit and loss adjustment account. Now keep it in mind, profit and loss adjustment account, we have done this in chapter 4 itself, is the other name of revaluation account. Okay, so profit and loss adjustment account and revaluation account means one and the same. Cash account, partners capital account and balance sheet. So all of you can pause the video and make the formats. Revaluation or profit and loss adjustment account 5 to 6 lines. Partners capital account half a page. Cash account 4 to 5 lines. Balance sheet as on 1/4/17 after retirement, approximately 1 page. So make these formats, and once you are ready with the formats, play the video and understand the question. I hope you all are ready with the formats. So very first we start with capitals. Capitals of E, F and G 8,000, 5,000 and 2,000. Write down in partners capital account on credit side by balance brought down. Capitals are 8,000, 5,000 and 2,000. So E 8,000, F 5,000 and G 2,000. General reserve we will distribute between all the partners in old ratio 4:3:3. So the entry for that is general reserve account debit to partners capital account. To all partners capital account. So partners capital account on credit side by general reserve now amount 2,000. So 2,000 into 4:3:3 ratio. 2,000 into 4 by 10 800. 2,000 into 3 by 10 600 and again 2,000 into 3 by 10 600. Also keep it in mind, I have given you the shortcut left right. In balance sheet general reserve is on the left side. So in partners capital account we will write it on the right side, opposite side. Single effect only, because the other effect is general reserve account gets closed. Now for goodwill. All partners capital account debit to goodwill account. So all partners capital account means in partners capital account on debit side to goodwill account. Amount is 1,000 in the ratio 4:3:3. So 1,000 into 4 by 10 400. 1,000 into 3 by 10 300 and again 1,000 into 3 by 10 300. Here again right left. In balance sheet it's on right side, so in partners capital on left side. Shortcut you all can always remember. Now let's take up with the adjustments. Following terms of retirement were decided in partnership agreement and among the partners. Very first, goodwill of the firm is valued at rupees 7,000. Now before we take up with that, we need to find the new ratio and gain ratio. All of you see the question thoroughly. Adjustment 1 goodwill, 2 land and building furniture, 3 stock, 4th amount paid to EN, FNG, etc. Now, are you given with any new ratio or gain ratio in the question? No. Since new ratio and gain ratio is not given in the question, if E has retired, you cancel E is 4. So 3 is to 3 between F and G is the new ratio as well as gain ratio. Okay, I repeat. 3 is to 3, what remains between F and G, old ratio of F and G, 3 is to 3, itself is new ratio as well as gain ratio. And what do you mean by 3 is to 3? 1 is to 1. Both are divisible by 3, so 3 divided by 3, 1, 3 divided by 3, 1. In short, new ratio and gain ratio both are 1 is to 1. So now we can make the workings of goodwill. Goodwill is valued at 7,000. So all of you write down after the balance sheet. Working note 1. For goodwill, we always make the workings and show the journal entry before we give the effects. What is the entry to be passed for goodwill in this chapter? Yes, what is the entry to be passed for goodwill? You all must remember. Remaining partners capital account debit. E has retired. So who are remaining partners? F's capital account debit. G's capital account debit. Okay, remaining partners means after retirement of E, F and G capital account debit to retiring partner capital account. Who is retiring? E. So to E's capital account. Now very first we'll calculate the amount of E. Goodwill into retiring partner's share. So all of you can see here that the value of goodwill in adjustment 1 is given 7,000 into retiring partner's share is 4 by 10. Okay, 4 is to 3 is to 3 means retiring partner's share in that 4 is to 3 is to 3 is how much? 4 by 10. So goodwill 7,000. Okay, goodwill 7,000 into retiring partner's share 4 by 10. Means what will be E's share in goodwill? 2,800. Now this we have to distribute between F and G in gain ratio. Okay, and what is that gain ratio we discussed just now? 1 is to 1. Okay, as we discussed, the old ratio of F and G 3 is to 3, that is 1 is to 1 itself is new ratio as well as gain ratio. So we'll distribute it equally, means 1400, 1400. Okay, 2,800 into 1 by 2 and 1 by 2, 1400, 1400. Now effects. F's and G's capital account debit means in partner's capital account debit set amount will come in F and G column, opposite account to E's capital account, in bracket goodwill. Okay, to E's capital account in bracket goodwill, in F's column 1400 and in G's column 1400. Now to E's capital account means in partner's capital account credit side, opposite accounts by F's capital account and also by G's capital account. Amount will come in E's column 1400, 1400. Again in bracket you can mention goodwill. So all of you must be clear with the entries of goodwill. If any confusion, advisably pause the video, rewind it and listen to that once again. Okay. Now next adjustment. Value of land and building is 7,000. Now in the balance sheet put tick on land and building, it is 6,000. Now its value is 7,000, means we should be happy. It is increasing by rupees 1,000, 1,000 of profit. So happy means credit revaluation account, and what you will debit is land and building account. So land and building account debit 1000 to revaluation account 1000 with the profit of 1000. To revaluation or profit and loss adjustment means in revaluation account on credit side by land and building account with the profit of 1000. And land and building account debit, it's a debit balance, we debit it again, so debit plus in land and building. So land and building on asset side 6000 plus appreciation of 1000, so outer column 7000. Okay, otherwise also the value of land and building has increased from 6000, it has become 7000. It has increased. Increase means we will add in land and building. And profit we are happy, so we will credit in revaluation account. Next, and furniture rupees 2000 is decided. Put tick on furniture in balance sheet. You can see it is 3000. Now 3000's furniture is now 2000. So should we be happy or sad? We should be sad. Here there is a loss of 1000. From 3000 it has become 2000. Now sad means we will debit revaluation account. And what will you credit to furniture account with the loss of 1000. Revaluation account debit. So in revaluation account on debit side, opposite account to furniture account with the loss of 1000. And to furniture account, furniture is a debit balance but we credit it. So debit credit means minus from furniture. So asset side furniture 3000 minus depreciation of 1000, so outer column 3000 minus 1000, 2000. Otherwise also the value of furniture has gone down. From 3000 it has become 2000. Since it has gone down, it has decreased, we will minus from furniture. And since it is our loss, we will debit in revaluation account. Next, stock is overvalued by 10%. Market important. Now be careful everyone. Very first impression what will come in your mind is that stock is overvalued means it is our profit. We should be happy. No, it's not like that. Stock is overvalued by 10% means what? It is not given stock is to be overvalued. If it is to be overvalued means now its value is 10% more, we should be happy. Stock is overvalued by 10% means put tick on stock. This stock 6600 is already overvalued by 10%. When they say stock is overvalued by 10%, means this stock given in balance sheet is overvalued means its value is already taken 10% more, whereas its actual value is 10% less. Now 10% less means again you cannot do 6600's 10%. So all of you understand what does it mean. Okay, look at this workings carefully and mark it very important. I would repeat it twice, but if required you can listen it thrice, 4 times, 5 times also by dividing it. Suppose the cost of stock is 100. Now it is overvalued by 10%, so we will add plus overvalued by 10% means its actual value or book value is taken as 110. Okay, its cost is 100 but overvalued by 10%, means in the books it is overvalued. So what is the value taken in the books? 110. Now book value means what is the value in the books? Actually 6,600. The book value is actually 6,600. So what would be its cost? 6,600 into 100 divided by 110. 6,600 into 100 divided by 110. So its actual cost would be 6,000 rupees. Now 6,600's cost is 6,000, means if we have to bring it back to cost, we have to decrease it by 600. If we have to decrease the value of stock by 600, will we be happy or sad? We will be sad. So revaluation account debit with the loss of 600 to opposite account stock account with 600. Now you can cross check. Actual cost of stock is 6,000. So if they say it is overvalued by 10%, what is 6,000's 10%? 600. If it is overvalued by 10%, then 6,000 plus 600, is it shown at 6,600 in the books or not? So this is the cross verification that our calculations are correct. Actual cost of stock is 6,000. It is overvalued by 10%, means it is taken more by 600. So its value taken in the books is 6,600. All of you listen carefully. I am explaining it one more time. But if required further, you can rewind the video and listen to that again and again. Very first of all, stock is overvalued by 10%. We should not be happy for that. The book's value 6,600 is already overvalued by 10%, means its actual cost is less, and this value shown in the book 6,600 is already 10% more. So how would we find what is its actual cost, and we have to decrease it by what amount? What we do is we assume that suppose the cost of stock is 100. It is overvalued by 10%, means the book value shown is how much? 110. 100 plus overvalued 10, so the value shown in the books is 110. Now what is the value shown in the books on the asset side? 6,600. So what should be its cost? 6,600 into 100 divided by 110, 6,000. Now value shown in the book 6,600, actual cost 6,000, means we have to decrease it by 600, so we should be sad for that. Sad, it's a loss of 600, we have to decrease it by 600. So revaluation account debit and opposite to stock account. Revaluation account debit, so in revaluation account on debit side to stock account with the loss of 600 in bracket, all of you write working note 2, and what amount? 600. And to stock is a debit balance, but we credit it, so debit credit minus from stock. Asset side, stock 6,600 minus, we have to decrease it by 600. So outer column 6,000. Okay, otherwise also we have to decrease the stock by 600, so minus from stock, and since it is our loss in revaluation account, we write it on debit side. Any confusion? You can rewind it and repeatedly see this part of the video to understand it thoroughly. Next, 5,000 is to be paid to E immediately. Okay, 5,000 is to be paid to E immediately, and balance to be transferred to his loan account. First of all, if we pay 5,000 to E immediately, then E's capital account debit to cash account. So in partner's capital account on debit side to cash account, in E's column 5,000 we pay to E immediately. To cash means cash account on credit side, by E's capital account we pay 5,000 to E immediately. Now you might get confused that we have only 400, but how can we pay 5,000? Don't worry, right now we are just doing the accounting, but actually the amount is less, so it will be brought by the remaining partners F and G. Then only will be in a position to pay 5,000. Okay, we'll see that in the next adjustments, but presently 5,000 to be paid to E immediately. So E's capital account debit to cash account. E's capital account debit, so partners capital account debit side to cash account in E's column 5,000, and to cash account, so cash account credit side by E's capital account 5,000. Further, and balance to be transferred to his loan account, so that we will do after the balancing of revaluation account. Whatever balance remains in E's column would be transferred to his loan account. Okay, this we have to do after revaluation accounts balancing. Okay, whatever balance remains in E's column will transfer it to loan. Now F and G will bring necessary cash in equal proportion. Okay, F and G will bring necessary cash in equal proportion, means 1:1 ratio, in such a manner that E is to be paid his dues fully. Now when they say E is to be paid his dues fully, don't get confused. Don't get confused that in adjustment 3 and 4, how can they mention contradictory things? You may feel that in adjustment 3 they are saying 5,000 to be paid to E immediately, and now they are saying E is to be paid his dues fully. Okay, now understand this. When in adjustment 3 they have already mentioned 5,000 to be paid to E immediately, so what are to be paid as the dues immediately? 5,000 only. Full dues fully doesn't mean whatever amount is remaining. We have decided that 5,000 to be paid to E immediately. So right now what are the dues to be paid to him immediately? Right now that full amount of dues to be paid immediately is same 5,000 only. So when they say E is to be paid his dues fully, means the amount decided to be paid to E, that is 5,000, that we pay fully. And also 2,000 is to be kept or remain as working capital cash. Now this we have done in the previous question 14, so all of you must understand this. The workings, how did we do? Okay, so 2,000 should be remaining in the firm as working capital, means that extra amount F and G will have to bring. Once again, F and G will bring necessary cash in equal proportion in such a manner that E is to be paid his dues fully. What are the dues to be paid to E fully here? 5,000 only as decided in adjustment 3. And also 2,000 should remain as working capital. So how much amount E and F will have to bring? Now understand this through a working. First of all, what are we finding in this working? We are finding the amount to be brought by F and G. Okay, what we are finding in this working is amount to be brought by F and G. Now, how to get that amount? First of all, what are the dues to be paid to E? 5,000. Okay, what amount do we have to pay to E? 5,000. Did you all understand this? 5,000 is to be paid to E as given in adjustment 3, and in adjustment 4 also, as I said to you, E is to be paid his dues fully. Here fully doesn't mean full amount. Fully means as decided in adjustment 3, that full amount of 5,000. Okay. Now we have to keep 2,000 as working capital, but we have only 400 rupees in cash. So how much extra amount should be brought? For working capital or cash balance to be maintained. Okay, working capital or cash balance required to be kept is 2,000 rupees, right? So 5,000 we have to pay to E, plus 2,000 we have to keep as cash in the business. Okay, this is the cash balance to be kept in the business. Working capital means this much cash we will need in the business, we have to keep it. So we require total 7,000 rupees for this, minus what is the cash already available. Cash already available is 400 rupees. Okay, cash balance brought down, opening balance 400 is already there. So further what amount F and G will have to bring to make it 7,000? 6,600 is to be brought by F and G. It's a normal calculation to be done. I repeat it one more time. If not clear, you can listen n number of times by rewinding the video. Look at adjustment once again. It is given F and G will bring necessary cash. So what is that necessary cash to be brought by F and G? That we have found here, 6,600. In equal proportion, in such a manner that E is to be paid his dues fully. Here E is to be paid his dues fully means as per adjustment 3, what are the dues to be paid to him fully? 5,000. And also 2,000 should remain as working capital or cash balance. 5,000 we have to pay to E. 2,000 should remain as cash balance working capital, so we require 7,000 in the business. But only 400 rupees is there as opening balance of cash. Okay, only 400 is there as cash balance already. So remaining 6,600 is the necessary cash to be brought by F and G. Now, how are F and G going to bring that? Equally as given in the last adjustment. How are F and G going to bring this 6,600? You all can see here equal proportion 1:1. F and G will bring necessary cash in equal proportion. So 3,300, 3,300. Okay, 6,600's half. What amount will F and G bring equally? 3,300. F will bring 3,300. G will bring. Now what will be the entry if F and G bring these amounts? Cash comes in, debit what comes in? Cash account debit 6,600. F is the giver, credit the giver to F's capital account. F brings 3,300. G is the giver, credit the giver to G's capital account. G also brings 3,300. Did all of you understand this? So cash account debit means in cash account on debit side, both the opposite accounts to F's capital account, he is bringing 3,300, and also to G's capital account, he is also bringing 3,300. I hope everyone is clear with this. To F and G means in partner's capital on credit side by cash account, in F's column 3,300 and in G's column 3,300. Okay, so if any confusion, rewind and see that again and again. Last adjustment is also done. Now prepare profit and loss adjustment, cash account, partner's capital and balance sheet. First we record unticked items. Capitals recorded, general reserve recorded, creditors 8,000 on liabilities side. Then after creditors, bills payable 2,000 on liabilities side. Now liabilities side is done. Asset side, freehold assets 3,000 on the asset side. Unticked items. Okay. After freehold assets, goodwill, land and building, furniture, stock recorded. Debtors 7,000 on the asset side. Okay, then cash is ticked means recorded. Now we do the balancing. Revaluation account debit side 1600 minus 1000, so 600 will remain by partners capital account. We have to distribute it between the partners in old ratio. All the partners EFNG 4 is to 3 is to 3. So 4 by 10 600 into 4 by 10 240, 3 by 10 180, and again 3 by 10 180. Opposite side in partners capital account 2 revaluation account 240 180 180. Now as we have discussed earlier also, very first we will balance the retiring partner E's column. Okay, and whatever balance is remaining we have to transfer to his loan account. So for E 8,000, 9,000, 10,800, 11,600. Both the sides 11,600 minus 400 5,240, so 5,640. 11,600 minus 5,640 will be 5,960 to E's loan account. Okay, balancing figure we have to transfer to his loan. So to E's loan account. In bracket balancing figure. Now E's loan 5960 will come on the liability side. E's loan 5960. Now FNG's remaining balance will come on the liability side. So 8,900 for F credit side total. G's credit side total 5,900. 8,900 and 5,900. 8,900 minus 171880. So 1880 if we subtract, then 7020. Okay, remaining balance 7020. Same way 5,900 minus 1880, again same amount 5,900 minus 1880, so 4020. Two balance carried down. On the liabilities side we will write capitals F G 7020 and 4020. So 11,040. Now cash balance we have to write on the asset side. So cash 7,000 is debit side total minus 5,000. What remains is 2,000. By balance carried down. And see what was the working capital required to be maintained? 2,000 rupees. So are we left out with 2,000 cash balance or not? This is again a cross check. Whatever working capital is left out to be or mentioned to be kept in the business, that you must have as the closing balance of cash. Okay, whatever working capital is required in the business, that must be left out as closing balance of cash. So asset side we all will write cash 2000 closing balance. And now let's see the balance sheet gets tallied or not. First, liabilities side 11, 16, 24, 26, 27,000. Now all of you check on asset side 7, 9, 15, 18, 20, 27. So it gets tallied. Okay. So once again, what are important points are there in this question? Very first is this stock overvalued by 10%. Refer to that once again. Practice it once again. Then this 5,000 paid to E and then F and G bring equal amount to keep 2,000 as working capital. These 2 points are important in the question, so revise them thoroughly. Okay, that will be all for this lecture. Bye everyone. See you. Take care.